The button you click before pressing buy can cost you thousands of dollars, and most people don't even know it's a choice.
If you're watching this, you've probably opened your brokerage app, hit buy, and been stopped cold by a dropdown asking you to pick an order type. I'm Grace, and today we're going to walk through every option so you know exactly which one to pick.
5 order types: market, limit, stop, stop limit, and trailing stop. We'll cover what each one actually does, when to use it, and the one most long-term investors should default to. Before we get into the order types, one quick thing, because this trips up almost every new investor. When you place a trade, it doesn't happen instantly. Your buy order has to find someone else willing to sell. The market is just one giant matching engine. Your order gets paired with theirs, and only then does it execute. On big stocks like Apple or Microsoft, that match happens in milliseconds. On thinly traded small caps, it can take minutes, hours, even days. The order type you pick decides what happens in that gap. That's why this matters. Order type 1, the market order. A market order says one thing: buy or sell right now, whatever the best available price is. You get instant execution. What you give up is control over the exact price you pay. Because in the split second between you clicking buy and your order matching with the seller, the price has already moved. You see $50 on screen. You click buy. By the time your order routes and fills, you paid $50.20. That gap is called slippage. On a liquid name like Apple or an S&P 500 ETF, slippage is usually a fraction of a percent. On a thinly traded small cap, it can run 1 to 5%. On the wrong day, even more. And on the wrong day, you get the May 6, 2010 flash crash. The Dow Jones dropped about 1,000 points in 10 minutes. Around $1 trillion in market value evaporated, then mostly came back. During those 10 minutes, Accenture briefly traded at 1 cent, a stock that was at $40 minutes earlier. Sotheby's printed at 99,999. Whoever sold Accenture at 1 cent, they almost certainly used a market order. The order said, "Sell now at any price," and that was the only price the market could find. That said, for most people, most of the time, market orders are fine. Liquid stocks, big ETFs, regular market hours, long-term holdings. The slippage is usually pennies. Order type 2. The limit order. A limit order says, only fill this trade at my price or better. Say a stock is at $110 and you only want it at 100. You set a buy limit at 100. The order sits there, waiting. It only fills if the price actually drops to your number. It's a patience play. You're saying, I'd rather wait or miss the trade entirely than overpay. You get price control. You risk the order never filling at all if the stock just keeps moving the wrong way. Here's something most beginners don't know, and I think it'll change how you think about limit orders. A 2025 study that analyzed over 27 million retail orders found that about 65% of retail limit orders end up fully filling, even when traders set them well outside the current best price. And those filled limit orders saved meaningful money, about 8 basis points on large stocks, 18 on mid-caps, 21 on small caps versus market orders. A basis point is 1/100th of 1%, so 21 basis points on a $5,000 trade is about $10.50. Small per trade, real over hundreds of trades. Order type 3, the stop order.
A stop order, sometimes called a stop loss, sits silent until the stock hits a price you set. Once it hits, the stop converts into a market order and fills at whatever's available next. Classic use case. You own a stock at $100 and you don't want to lose more than 10%. You set a stop at 90. If the price falls to 90, the trade triggers automatically. Think of it as a circuit breaker on your position. It cuts you out of a bad trade without you needing to be watching. That's the value. You don't have to babysit your portfolio every hour to protect yourself from a serious drop.
But there's a catch, and it bit a lot of people in 2010.
During that flash crash we talked about earlier, some stop-loss orders filled 40 to 60% below the price they were supposed to trigger at. Because remember, once your stop triggers, it becomes a market order, and in a panic with no buyers around, the next available price can be a long, long way down. Which brings us to order type 4, the stop limit order. A stop limit takes the stop and bolts a guardrail onto it. You set 2 prices instead of 1, the trigger and the worst price you'll accept once it triggers. Same stock at 100, you set the stop at 90 and a limit at 85. Now, if the stock drops through 90, your order triggers, but it will only fill if it can get you 85 or better. The upside, you don't get cleaned out at the bottom of a flash crash. The downside, if the stock blows right through your limit and keeps falling, your order just doesn't fill. You're stuck holding it. It's a parachute that might not open. Better than no parachute, sometimes worse than a market order ejection.
And finally, order type 5, the trailing stop.
A trailing stop is a stop order with a moving floor. It follows the stock up, but stays put when the stock goes down. Say you buy at 100 and set a 10% trailing stop. Your initial stop is at 90. The stock rallies to 150. Your stop ratchets up to 135. It hits 200. Your stop is now at 180. The stock pulls back to 180, and you're out, with most of the game locked in. It's a ratchet. The stop only ever clicks one direction, toward locking in profit. The risk, a healthy stock can pull back 10% on its way to doubling. A trailing stop set too tight will kick you out right before the move you actually wanted. So, 5 order types. Which one should you actually use?
It depends on which side of this picture you're on. If you're investing for the long term, buying index funds, holding quality companies for years, market orders are fine for most trades. Use limit orders if you're touching small caps or trading at weird hours. And honestly, skip stops entirely. You don't need a circuit breaker on a 30-year holding.
If you're actively trading, day trading, swing trading, holding positions for weeks, not years, the other order types earn their keep. Limit orders for clean entries, stop limits for downside protection, trailing stops to ride a winner without giving back the gains.
For most people watching this, most of you, honestly, investing is a long game. The order type you use almost never decides the outcome. Time in the market does. The takeaway: match the order type to your time frame, and you'll get this right 99% of the time. Like and subscribe for more.